All right, so we're being recorded. So about 45 minutes, please input your questions if you have them, and let's start. Okay, so the CARES Act, that's the title of today's presentation. That's what we're mostly focusing on. So for those who are unaware, the CARES Act is the piece of legislation that was passed to address the coronavirus COVID-19. It was passed less than 3 weeks ago. So on Friday, it will be the 3-week anniversary. It feels like a lifetime ago that they passed that thing, but it's only been not even 3 weeks. Today's presentation is by me, Clemons. I'm an associate attorney at Cunningham Legal. Jim is the president of Cunningham Legal, the founder of Cunningham Legal. And both our background is really in tax and estate planning. I have my master's in taxation law. Jim is a certified specialist in estate planning, trust, and probate law. I see a lot of my former clients on the participants. I really appreciate you coming to join us today. If you worked with another attorney here, we appreciate you all the same. Today's presentation, about 45 minutes, so just bear with us. We're going to go through the Cunningham Legal story in case we have any new clients here or potential new clients. I'm going to cover the Secure Act. Now, I've been talking about the Secure Act quite a bit since it passed in December. This is the one that changed RMDs, changed inherited IRAs, but I know we have a lot of people that still have yet to really go into the details of the Secure Act. We are going to discuss the CARES Act. Jim's going to be giving his commentary on it. We're going to talk about how the CARES Act affects retirement accounts, because so many of our clients, that's their biggest asset, is their retirement account. And then, as I've said before, we will allow questions and answers after the presentation is over. All right, one quick piece of housekeeping advice. Everything we talk about today, it's totally for educational purposes only. It is our opinion as well. It is not legal advice. Okay, nothing here is legal advice, because I haven't seen your unique situation. I haven't been able to analyze your situation, and neither has Jim. Now, just to give you some background on our firm, Jim founded the law firm in 2005. Jim, you can see him top right and the top left of my screen. He wrote a best-selling book on estate planning called Savvy Estate Planning, Amazon.com, really easy read. If you haven't read it, go ahead and look. We have 6 associates in the firm. You can see me, Clemons, top left. Firms, we have offices throughout California. And right now we're doing video conferencing because we're respecting the social distancing that is in place. So if you'd like to make an appointment, it's going to be via video conference or phone. We're even able to sign via video conference. Thank you, Jim, for getting that arranged with the judge last week. Jim, would you like to introduce yourself?
Yeah, hey, I'm Jim Cunningham. Connor, thanks for that introduction. And you mentioned something, the stay-at-home order. This is an order that the governor has signed. It's an executive order. It's an emergency order, and we're lawyers. This order has the force of law, and I've been talking to a lot of lawyers. I've been on all the various legal specific blogs. There are still lawyers meeting with people and violating the judge's order. We are not an essential business as the governor's defined it. So this is very important. This is not yes, we want to keep our clients safe, and that's the number one concern, and our employees safe. But also we have to follow this executive order that the governor's put in place because it's the law. I mean, we simply just can't meet with clients, period. So that's how we're interpreting this, and this really is for everyone's safety. I saw in the LA Times a poll that 95% of people polled by the LA Times supported the shelter in place. We take this very seriously. This is putting a lot of people at risk. Personally, I got to tell you, I think my daughter had it in January. I think my brother-in-law had it in February, or in last November, and I think this is part of that herd immunity. But you know what? If the governor says stay at home, we're staying at home. We sent all of our staff home March 16th, and we were slightly ahead of it. But again, the safety of our employees is paramount, and the safety of our clients is paramount.
March 16th, it's been a long month since March 16th.
Yeah, that's rolled away.
For everybody. All right, thank you, Jim. And as I said before, we are doing video conferencing via Zoom, via telephone conference, whatever it takes, because so many of our clients, they're concerned, especially right now.
Right.
So let's jump right into it. Now, the Secure Act, this was brewing for several months. This was a law that was passed in December, and it changed the most popular retirement plans in the US, 401ks, IRAs. If you have one of those, it affects you. Now, the goal was two parts. One, to increase equity in retirement savings, afford more opportunities to Americans to save for retirement, and then also, of course, to raise revenue. So what the big part of the law was is two things. Number one is, for years, you had to require minimum distribution on these IRAs, which means that the government, they forced you to pull money out of your IRA, a traditional IRA, when you turned 70 and a half, and they forced you to pay taxes on it. So very bittersweet moment for a lot of folks. Well, they increased that minimum age from 70 and a half to 72. That's what happened in December. That's the first part of it. So if you have an IRA and you're not yet 72, you don't have to pull any money out, which is great. A lot of people are living longer. A lot of people are working longer. They're worried about running out of money. And this tries to deter that. Now, the other part of the Secure Act, and that's what really affects us, is the stretch IRA was eliminated. A lot of our clients, they really set up plans that would use this stretch IRA for their beneficiaries to make a lot of money. We've been using this strategy for quite some time to make beneficiaries money, to stretch out an IRA over a beneficiary's lifetime. And Congress sort of caught on to it, and it was too good to be true. They changed it. So now when somebody inherits an IRA, generally, there are some exceptions. You have to pull out that money within 11 years. You get that first year free that somebody passes away. But then after 10 years, you have to pull out the money. And if it's your traditional IRA, you're going to pay tax. So the beneficiary is going to pay tax. Ordinary income, if it's a Roth IRA, the money still has to be out after that 11 years. But of course, there is no tax for the beneficiary. Jim, do you have something to add here?
Well, a question came up from Laura. Hey, Laura, how you doing? What are the requirements, which types of retirement accounts, and limitations on borrowing on retirement accounts? So that was something that the CARES Act, typically it's about a $50,000 limit before the CARES Act. And now that's been raised to $100,000, I believe. And that permits you to borrow from your 401k. Now, this is really important. If you borrow from your 401k, that's probably the last source you want to tap into to borrow, because you have to liquidate funds. So it's not like you margin a security. It's not like you keep that 100,000 invested in an IRA and you pull money out and you borrow. You liquidate the investments. And of course, we're in a we're in a bear market. This is not the time to liquidate investments if you at all possible. So this is a time really to be investing or to stay invested and ride that back up. Historically, markets do rebound within a period of time. They don't stay down perpetually in this sort of a low point. Now, here's the so the 72 number, what the statute says is people born July 1, 1949 and later do not have an RMD until age 72. Now, what this means is, as we put money into our retirement accounts, our 401ks, our IRAs, so we at our firm, we have a 401k and we match the 401k. And Connor actually was instrumental in getting us to put in a Roth 401k, which we're going to talk a lot about Roth in a few moments. But the idea is you put money in for your whole career, and then after you retire, once you hit that 70 and a half or 72, you have to take out a certain amount, and it is a percentage based on your age. Really, it's a percentage based on your year of birth, frankly. So whatever that number is on the IRS chart, that is the percentage you have to take out of your account. And for those of you who have minimum distributions, you know exactly what I'm talking about. Whether you want to or not, you got to take it out. And then eliminating the stretch IRA. So it's been called the 10-year rule. I like to call it the 10th year rule, which is a slight, grammatical nuance. But what that means is if somebody dies in 2020, you don't have to withdraw that money until the December 31 that contains the 10th anniversary. So someone dies in 2020, that money doesn't have to come out till December 31 of 2030, which is actually 11 tax years. And so we'll be talking a lot about that in the future. But this is very important. The old rules, to get that 10-year stretch, the old rules still apply. So if you blow it, you only get a 5-year. If you've heard of the 5-year rule, that means all the money has to come out in 5 years. In order to get that 10-year rule, you still have to follow all the old rules. And this is, basically getting a lot more complicated. So David asked, with stretch IRA gone, what is the strategy to pass on to the beneficiary without killing them with the taxing of withdrawing in 11 years? Well, David, I'm so glad you asked that, because we're going to be talking about that in the next few slides.
All right, good job, Jim. All right. So people have IRA trusts. People are still interested in IRA trusts. What does an IRA trust do? Well, IRA trusts back in the day, the whole goal was to effectuate that stretch out. Now the analysis has totally changed because we still like the stretch out, but stretching out over 40 years just isn't the same as 11. Now, still, your beneficiaries need to plan every single year how they're going to take money. Because let's say you leave $500,000 to one of your kids. If they just take out that money in year one, that's going to be $500,000 in income. If they let that money grow over 10 years and they don't take money out and they sit there in year 11 and they have all this money to withdraw, that's going to be even more money. And I don't know if you're familiar, but California, our highest tax bracket right now, when you combine federal and state, is 50.3%. So potentially, if somebody pulls out all that money in 1 year, they could be paying 50.3% tax. So an IRA trust now, the goal is really three things. Number one is to actually plan strategically to take out a little bit of money every single year. Jim, I think you call that.
Well, maybe. Well, maybe though. But and this, we may be getting a little ahead of ourselves. But the point here is this, folks. This planning, it used to be complicated. It used to be, take a lot of brain power to figure this stuff out. Now it's even more complicated. And what we're going to be talking about, a little bit of teaser on this, is a Roth conversion. So the big problem here, frankly, is the tax problem. And so what you've got, so what we're saying is if somebody dies in 2020 and they inherit an IRA, there is no minimum distribution. It doesn't matter how old you are. There is no minimum distribution until December 31 of 2030, which is 11 tax years from now. It's 10 years and a little bit from now. There's no minimum distribution. So the question is, do you let that money ride and roll and continue to grow and take it out in the 11th year? Or do you take a little bit out every year? Or do you take all of it out now? These are really complex analyses that involve, frankly, tax bracket management, meaning if you make $1 million, you pay tax at a higher rate than if you make $10,000. In fact, you don't pay any tax. The government gives you money, right? That's the earned income tax credit. So the idea here is tax bracket management. California has an income tax. And the big question is there a way to avoid or at least delay the California income tax? The tool of a trust. And by the way, a trust is not the be all, and the IRA trust is not the be all and the end all. It's really case appropriate. If you're going to leave your IRA to a charity, if you say, I'm going to leave it to the American Red Cross, $1 million in an IRA, just name them beneficiary and let that go and give it to the Red Cross. They're not going to pay taxes on it. Okay. Now you could hold it for 10 years, theoretically. I mean, it's a bad example with the charity, but the point is, it's on a case-by-case basis. So now for those of you who we did an estate plan for, and you said, gee, I spent all this money on this great estate plan and this IRA trust. Did I waste my money? The short answer is probably not. We don't know. So give us a call. And now's a great time because we're all sitting at home working and you're sitting at home and no one's going anywhere. But now's a great time to go over your estate plan and go over all of these issues.
And there are a couple moving parts to the IRA. The stretch out is still available for certain people, like based on age discrepancies between the participant of the plan and the beneficiary of the plan. Also, disabled children, disabled adult children, they can use the stretch out as well. So it definitely is going to be a case-by-case basis to have your IRA reviewed to decide whether to take that money slowly or to try to stretch it out if possible. IRAs, they still provide asset protection. The IRA trust provide asset protection. If somebody inherits an IRA and it goes straight to the beneficiary, there's no asset protection. So if the child gets divorced, if they get sued, that money is going to be part of the lawsuit, part of the divorce. And then a point that a lot of my clients still care about is when an IRA trust is implemented, you're able to name a contingent beneficiary on your IRA. So like if you leave your money to your daughter, you're able to leave as the contingent beneficiary her children as the contingent beneficiary.
Yeah, this is super important. And there are 4 ways that the inherited IRA can be. What happens to your inherited IRA? Let's say you inherit this IRA and you're named as the individual beneficiary. You don't have a trust. It depends on what the original person who set up that IRA, it depends on the documents they signed when they set the IRA up. Now, seems crazy to a lot of people, but there is one company out there that says whoever the contingent beneficiary was that was named originally by the original person, right? So if it's my IRA, I leave it to my son. whoever the original contingent beneficiary after my, if my son didn't survive me, whoever that contingent beneficiary was, is the person who inherits the IRA, which is really crazy, which means the person who inherits the IRA can't decide who they want to leave it to. So in many instances, an IRA trust or whatever other planning you're doing gives you a lot more control. So it's something to be mindful of. Who inherits that inherited IRA?
I mean, yeah, just one more note and we'll shift gears. These IRA, when people set up IRAs, remember, if you leave it straight to your daughter passes away. If you don't have a plan in our community property states like California, that money is going to go to her spouse, not the kids, because that's what these financial advisors typically do. If you have an IRA as beneficiary, you can control that contingent distribution. Okay, so like I said, let's shift gears, move on a little bit further. So what do you do now with an IRA trust? Like Jim said, have it reviewed. There's so many different answers. People have them set up different ways. We're happy to review. If an IRA is your largest asset, I have a lot of clients where an IRA is worth more than the house they live in or several houses. Definitely have a discussion to make sure you can have it protected. So let's go on to the big part of this, which is the CARES Act. So the CARES Act, this was the legislation that was just passed not even 3 weeks ago. So CARES Act, it was passed to provide relief for the COVID-19 pandemic, particularly the economic fallout caused by the crisis. $2 trillion package, $2 trillion. That's
a lot of zeros.
A lot of money. You can see the zeros right there.
And that's, as we all know, if we've been listening to the news, that is the first slug of money. There will be more money.
And that's actually the way it was written, was fully the expectation that there will be more money passed in the near future. And this bill was passed unanimously by the Senate, which is, anytime you have Rand Paul and you have Bernie Sanders voting for the same thing, people really know that it's something that needs to be done. So we're going to go through the CARES Act. It has about 10 moving parts, and a lot of it has to do with retirement accounts. We're going to come back to it. We're going to talk about Roths. But let's go into the CARES Act in general. I'm going to break it down, and we'll start with the recovery rebate. So this is the tax credit that people are getting this week. Or really, it's supposed to be due by Friday this week. So if you haven't already got it, you should get it soon if you have direct deposit set up. It's going to be a check for $1,200 for most singles, $2,400 for most couples. Now, if you have children, minor children, you can receive up to $500 per child in addition to what you regularly would get. Now, obviously, this money phases out. So if you make over 75,000 and you're single, you can see the list here, 112,000 head of household, 150,000 if you're married, it's going to start to phase out proportionately. If you make over $99,000 as a single person or over $198,000 as a married couple, you will lose out entirely. Now, $198,000, that isn't that high in California for a lot of our clients, but in reality, in America, that puts you in the top 8% if you're making that $198,000 as a married person. Now, just like Jim said, they are fully expecting to have to implement another check in the future. Every time they send out a check for $1,200 to 250 million Americans, it costs $300 billion to do so. So they might do it again in May. Now, some particulars on this check is it's income tax free. So you're not going to pay taxes on this money. It's really a credit. Now, it's an advanced credit. I've seen a lot of rumors on the internet saying that if you take this money, it's going to count against your tax refund in the year 2021 when you file your 2020 taxes. That is false. This is a tax credit. You're just happening to get it now, early in April 2020 when you need it. And one final note, if you're married, if your income isn't $198,000 in 2020, or if you're single and it's not $99,000 in 2020, the government will give you this tax credit in the year 2021 after you file your taxes. They're only giving out the advance credit for people who had in 2019 income under this threshold.
Yeah, and Tina has a question. It says, Tina asks, I don't get tax refunds. I always owe and have withdrawal set up on the account. Will I still get the $1,200 deposited to this account I set up to pay my taxes owed? I believe so, as long as your income is under these numbers. And so if it's over, here's the bottom line. Here's the basic idea is the government needs to stuff money into people's pockets because the economy is shut down. It's a fact. A big slug of the economy is shut down. We happen to be open. Frankly, it's a little weird not meeting people in person by phone and video. I think you lose. I can tell you as a human being, I appreciate human interaction far more than I ever did at any point in my life ever. And it's weird to not interact with people. I think we're all, Connor, I know you're a super social person, so am I. And I think for the people out there who are, it's just weird. But that being said, is the whole point is to stuff money into the pockets of consumers and to businesses. So a part of the CARES Act that I don't believe we're going to be covering is the Payroll Protection Act. Are we going to talk about the payroll?
We'll cover it just briefly, just introduction so people become.
Yeah, but I mean, it's kind of like this on steroids for businesses, and it's essentially forgivable loans and grants up to $10 million for companies with less than 500 employees. I'm sure you've heard about that in the news. Lots and lots and lots of businesses are going out to get this money so that they can keep their people employed. Since we sent our people home March 16th, we have not laid anyone off. We've not reduced anyone's salaries. A lot of law firms in California are cutting salaries across the board 20%. I personally think that's the wrong thing to do because we need to keep our economy going. And it's kind of a patriotic thing, frankly, now is not the time to be kind of, stingy. I don't know, whatever you want to say, but we need to spend money. Go support the restaurants that you like. Go support the people, the stores, and all the other places that are open in the best way that you can. But it's really important to keep the economy going. We will get through this, and it will be different in the future. And I don't know, did Newsom release his plan today about getting California back up and running, or has that not been released yet?
I haven't seen it, no.
I haven't seen it either. Okay.
Okay, so just one more note to that question. Direct deposit people get it this week. If you are a check person, you'll get it next month. At least that's what they're telling us now. If you want to switch over, you can Google it. The IRS is setting up a portal for people to input their banking information for this check. So if you just have never got a refund, you've never linked your account, go there. Some of the third-party services like TurboTax and H&R Block, they're doing the same thing. They're trying to launch this portal.
And if you did not file in 2019, if you were not required to file, my understanding is you need to file a return for 2019, correct?
Social Security people who get Social Security, they're
Right.
good. That's what the IRS has said.
Okay.
Other people who haven't, go online and try to let them know you exist.
Yeah.
All right. So then we continue through to the Paycheck Protection Program. That's what Jim was just referencing. This is really stimulus, essentially, to try to cover operating expenses for small businesses from February 15th through June 30th. That's really how Congress is viewing this pandemic.
Yeah, and here's what's going on here is here's what the government does not want to have happen. The government doesn't want 35 or 50% unemployment. That'll be like way worse than 1929. This is not something that the government wants to happen. I think collectively as a society in the world, we don't want this to happen. There has been talk in Congress about basically the government making all payroll. And I think that was Mark Cuban's proposal, is make all payroll through June 30th. Just have the government cover everyone's paycheck. So it's, I think for all of us, this is the first time this has happened where the government is just handing out money. And I will tell you, I've talked to so many lawyers who are making an application for the payroll protection program. They're like, are they really going to forgive this? Is this really not taxable? So this is not taxable. This is a loan that is forgivable. So if you're retired, you may go, well, I don't really care about this. Well, you should, because a lot of businesses that would otherwise be firing all their people and closing their doors are going to stay open. And this is a really good thing. I was reading that in the area, in the Sacramento region, at least, they're talking about a third of restaurants closing permanently. So I think we're going to see a lot less restaurants open. But so here's what happens is you take your average payroll. So if you're a business owner, you take your average payroll for 2019 and you remove the pay of anyone over 100,000. So if you got an employee that's making 200,000, you take off that top 100,000 and you add up all the payroll for the whole year. You add in your 401k contributions, you add in your medical, and am I forgetting something? And then you divide by 12. And then the government gives you a forgivable loan of 2.5 months. So I guess that would be 5/24. They came up with this number. It sounds like a compromise to me. 5/24 of that annual payroll. And that is being given or loaned to businesses. And as long as the businesses keep the people employed, I believe it's for a 60-day period after funding, they can apply for the loan to be forgiven. The loan is not income. The forgiveness of the loan, typically forgiveness of debt, is taxable as income. This is not taxable as income. So the idea is to keep the economy going. Now, here I will just give you a warning. if you are getting a PPP loan and you try to game the system, I think the government is really going to crack. There's going to be a ton of fraud on this. I mean, everyone knows it. I think the government's just kind of accepting that there will be fraud. But if you do get one of these loans, what we're doing for our clients is when they've reached out to us and asked us, we're advising the clients to set that money in a separate account and keep a ledger. So, okay, your payroll, maybe it's twice a month. So you take the money out of that separate account and keep a ledger, because what's going to happen when you go through the application process to have the loan forgiven, you're going to need to document what you spent the money on, right? So you don't want to take that money and go do something that is not payroll, rent, utilities. So those are the biggie: payroll, rent, utilities, and mortgages. And now, this, I think, is the first funding. I wouldn't be surprised if there's further funding. I don't know when we're going to go back to normal, when the economy is going to be up and running. They're talking about another potential thing in the fall. We just don't know, but I would suspect there's going to be additional funding on this. So if you're a business owner, pay attention to this. If you're a business owner, you probably already submitted your application. But if you have a child or a relative that is a business owner, please share this information with them, because it's really important. I think the government is going to really scrutinize this several months out, maybe a year out. I think there's going to be a lot of fraud. I think there will be prosecutions. I think this will be in the news. But do the right thing and use it as the money. Government's giving you money. Pay your rent. Pay your people. Don't chisel down your landlord on the rent if you get this PPP money. I think that's going to come back to bite you.
Yeah, and a lot of people have been saying they haven't got their money yet. But like I said, it hasn't even been 3 weeks since the law was passed. It's only been 10 days since they accepted applications. So
Ray asked on the 12 and 2400, is the income limit based on the gross or adjusted income? My guess is it would be your AGI, if I had to guess.
AGI.
Or taxable income? I don't know. Which one do you think it would be?
AGI.
AGI, okay. And then Hugh, okay. I believe old IRAs could not be placed in an estate plan trust. According to your comments, a new IRA can be placed in an IRA trust. Please explain the difference. Okay. Your IRA is it's not in your name. It's held by a third-party custodian for your benefit, technically, but it is your money. Okay?
It's almost like a trust.
It's kind of like a trust. Actually, it is a trust. So here's what happens. I have an IRA, and I contribute to my 401k. I roll it over. I got $100,000 in my IRA when I retire. So not that big of an IRA. So I roll from my 401k over to my IRA, and I put that with a financial service, Ascent Wealth Management, let's say, right? So I put that with Ascent Wealth Management, and then I die. The ownership of the IRA never goes into a trust until I die. Okay, so this is an IRA. This IRA trust that we're talking about is something that you create while you're alive, and the beneficiary of your IRA you name as the IRA trust. Okay, so you name the beneficiary of your IRA, this IRA trust. I have an IRA trust. I've named a Nevada successor trustee, and my IRA trust is written under the laws of the state of Nevada, because I want to at least defer California income tax. And there are a line of cases that are working their way through the Supreme Court that stand for the proposition that in the future, when this big slug of money when that 100,000 becomes 200,000, right? When that money comes out, California income tax may never be paid on that money. Now, right now, it's at least delayed, but there's a real tax reason, if you're a California resident, to consider an IRA trust cited in Nevada with a Nevada trustee. So, and if that's something that's of interest to you, please reach out to us, and then we can talk to you one-on-one.
All right. Well, thank you, Jim. I guess I'm going to continue through CARES Act. One more note is I see the news kind of mixing up the Paycheck Protection Act and the Economic Injury Disaster Loan. CARES Act did expand upon this disaster loan. This is for businesses who are going through a disaster. It was really set up for things like hurricanes, but people are applying for loans under this act now. If you apply for a loan, you'll get $10,000 in relief in the form of a grant upon the application, even if you get denied for the loan. So this is the other part. This is the $10,000 cap that you might be hearing on the news. That's what they're referencing. All right, so continuing through, expanded unemployment under the CARES Act. I know people who have lost their jobs, sadly, over the past couple months, and they're worried about not having enough money to make their mortgage or make their rent. So federal funding for unemployment under the CARES Act has been expanded up to $600 per week, so $2,400 a month, in addition to your state benefits. So the state's going to pay you on on whatever they pay you, roughly half of your typical salary. And then you get the additional up to $600 per week from the federal government. So I was doing the math. Someone who makes $80,000 a year after unemployment, if they're laid off, they'll probably make $65,000 a year during COVID, and that is taxable money, unlike that credit we talked about earlier. Now, these benefits, they last up to 4 months. The federal benefits last up to 4 months. There is an expansion for those who are self-employed, independent contractors, those with a limited work history. They are able to apply. From what I understand, you should apply for this federal unemployment just to see if they'll give you funds. The federal government's going to fund an additional 13 weeks of state unemployment benefits all the way through the end of 2020. I was telling Jim this yesterday. When they were passing this part of the bill, the Unemployment Act, there were congressmen saying, well, this is going to encourage people not to work. And the other congressman replied, that's the goal of this. We're trying to make sure people don't work for the next 4 months.
Yeah, we want them to stay home.
Yeah. To not worry. So
exactly. You want them to stay home.
Keep that in mind. So that is the unemployment insurance is being expanded over the next couple of months. All right, so a couple more business tax provisions. Number one is if you're a business owner, you are eligible in a 50% refundable payroll tax credit on wages up to $10,000 paid during the crisis if you've had your company disrupted by COVID. So that's going to be a decrease in 50% of gross receipts. So that's going to be all restaurants, obviously, but quite a few businesses besides restaurants. They don't have to pay that payroll tax up to $10,000 for the COVID period. Now, Social Security payroll tax can be delayed for anybody an additional 6 months, both for the first half of 2020 and the second half of 2020. You have that extension in case that's going to benefit you in some way. Emergency lending to states. This is the one that's kind of through the Treasury. This is the one that Steve Mnuchin, Treasury Department, they can give out loans at discretions to businesses, to states, and to cities. Now, this also included the $25 billion bailout to the airline industry. Now, if you take, this is for large businesses, if a large business takes a loan under this process, then they cannot engage in stock buybacks for a year, or excuse me, for the duration of the loan plus 1 year. They must keep 90% of their employment levels. So we continue to see this pattern. The whole goal of the stimulus package, if you want to call it that, is to maintain employment. I mean, really, you look at the United States economy, it's about $21 trillion, $20 trillion. That means all the services in 1 year, all the manufacturing in the US is worth $20 trillion. This whole package is worth $2 trillion. They're effectively trying to replace, they're trying to artificially create 2 months of, or 1/10 of the entire GDP, the entire services sector of the United States economy for this whole period. There is no restriction on dividends for these companies, which is controversial during this time, but big companies, they're taken care of too under this whole package. I continue through. Finally, state relief, $150 billion going to the coronavirus relief fund. This is all directed to states and city governments. You see it in Sacramento, LA, San Francisco. It's allocated by population, but of course, you know, we're the federalist society we are. Every state gets at least $1.25 billion. So that's essentially the end of my presentation on the CARES Act. We're going to go into retirement accounts next. But Jim,
Hunter, quickly, we had a question. Is the $600 a week federal unemployment taxable in 2020? I don't think unemployment, are they taxable or not?
It's taxable. It's taxable. They will take their money back if you make enough money. Really, only that tax credit, that check they're giving out is tax-free. Otherwise, the government, when they give out money, they want their money back. And that makes sense because, you know, you see some people on unemployment who have a spouse that's still employed. They don't suffer the same way, but yeah. All right, so now I'm going to shift to retirement accounts and how they're affected by the CARES Act. So retirement accounts like IRAs, 401ks, they have just been totally disrupted by legislation, 2 huge pieces of legislation in December and in March now. So what does it mean for you if you have an IRA, if you have a 401k, 403b? Well, the first part is there's no RMD for the year 2020. There's no required minimum distribution. So if you're 72 or older, you can just let your money sit and ideally let it grow for another year if you're able to. Jim, do you have any comment on this?
Well, I guess it's a good thing because a lot of our clients frankly don't need it. And the RMD is, you know, once they hit or used to hit 70 and a half, now 72, you know, some of our clients have a $3 million IRA and it's $100,000. that's added to your income, and then it throws off the taxability of your Social Security, and it has some other side effects. So I think, it's a good thing for. I guess it's a good thing, right?
Yeah. I mean, either way, if you have an IRA and you don't have to take out your money this year, or even part of the money, just leave it in there, let it grow.
Well, hold on though. But what about Roth conversion?
We're going to come to Roth. That's the big payoff here.
Hold on to that. This is the big payoff, and this is why I said at the beginning, this planning has gotten a lot more complicated, is the bottom line.
So no RMDs for inherited IRAs either. If you happen to be sitting on an inherited IRA, whether it was pre or post Secure Act, you get 1 year off. So you can let that money sit, turn that year into, or that distribution into a 12-year distribution. You can still take money if you want to, or if you need to, sadly to say. So definitely consider taking a smaller distribution than normal. I've already had people ask me, what happens if I took an RMD? I take an RMD every January. Well, if you took the RMD, your financial planner, so Ascent or someone like Ascent, they can strategically contribute to a new IRA. So you essentially wipe out the taxable income. It can't go back into your original IRA, but they should be able to help you not have to pay taxes on the distribution. And remember, the whole reason why this passed was because they didn't want to force elderly people to have to liquidate stock or their bonds when everything's down. Right. So keep that in mind. That's the whole purpose here, is not to force that distribution. And S&P 500, I forgot what it's at this morning, but it's certainly not at its all-time high. Make sure to really consider before you start liquidating your stock.
Yeah, you don't want to eat your seed corn. I mean, that's the bottom line. And this is why it's important to have a financial advisor. Okay, is most people with a financial advisor, if you have money in an IRA, you have some cash. Now, why would you have cash? Well, because you're going to have a minimum distribution, and you don't necessarily want to be liquidating assets when they're depressed, when you hit that minimum distribution. So something to consider in your in any account where you have a minimum distribution, you may want to consider having a slug of cash and talk to your financial advisor about how much that should be versus being 100% invested in the S&P 500 index fund, right? Because as it goes kind of up and down, your minimum distribution is going to be affected by that.
All right, so now we're going to get to Roth conversions and why Roth conversions are so encouraged. So I'm going to give background first, and then I'll let Jim chime in. So background, what is a Roth? I see a big discrepancy with my baby boomer clients versus everybody else, because Roth IRAs came around in the 90s. So with your traditional IRA or traditional 401k, when you put money in one of those accounts, you take a loss on your taxes. You don't have the income. You don't pay the income tax on it. And then one day when you pull out the money, that's when you pay income tax. Now, you're able to set up a Roth IRA as well, where you put in after-tax money, and all the growth ends up being tax-free as long as you pull out the money once you're 59 and a half or older. Okay, that's the key, just like with the traditional. Now, the benefit of that is if you start at a young age saving, there's going to be a ton of compound growth over the years, and you don't have to pay tax on any of it. You also don't ever have to take a required minimum distribution. And so there is some, I guess, theoretical dispute over whether an IRA, traditional IRA, or Roth is better. But you should certainly be allocated to both, or almost everybody here should be allocated at least a little bit to both to hedge your bets. Now, before I go on to inheriting one of these things, do you have anything to add, Jim?
Well, here's the deal. Here, folks, here's the headline with the Secure Act and even the CARES Act. And I said this planning has gotten a lot more complicated. So what I mean by this is, right, in 2020, there's no minimum distribution. You cannot take your minimum distribution and convert that to a Roth. You can't do that. You got to take something more than your minimum distribution. So this is the year, if you've ever thought about doing a Roth, okay, this is the year that you should consider doing a Roth. And what you're going to need to do is you're going to need to involve the three most important advisors when it comes to looking at a Roth conversion, in this order. Number one, your attorney. Number two, your financial advisor. And lastly, your CPA, okay? And the reason you want to talk to your attorney first is traditionally in tax planning, the attorney's the quarterback. The attorney's the one who schedules everyone out, makes sure that things get done. make sure that the meetings happen. There's an opening of the matter. There's a closing of the matter. That's what lawyers do. We're case managers effectively. The financial advisor, obviously, super, super important. They're very knowledgeable about how to execute the Roth IRA. And then once you do a Roth, we'll talk a little bit about that. And then the CPA is obviously very important, because what the Roth conversion strategy is about, fundamentally at its essence, is tax bracket management arbitrage. So what I mean by that is, if you make $1 million a year, you pay tax at a higher rate on, you know, those dollars that are close to $1 million than you do if you make 100,000 a year. And so what happens is, as your tax brackets go up, right, as you pay more tax, the more money you earn, it makes sense to think about, look, I've got a little bit more room in this tax bracket. You know, I could do a $20,000 Roth conversion on my $1 million IRA. Why don't I convert that 20? Because it's really not costing me it that much. Okay. Now, another thing you can do is you can make your other investments that are outside of your IRA. You can change, and this is where you work with your financial advisor and your attorney, and you make those investments be tax advantaged. So there's certain investments, you know, a lot of my clients, and I'm not mentioning one investment over another, but oil and gas investments, and some of you have bought oil and gas investments, they are a tax advantaged investment, meaning you put money in, you get some money, you pay less taxes. Solar credits, you put some money in, you pay less taxes. Film credits, probably a bad example because everything's shut down, but you put some money in, you get some money back. So there are some planning strategies out there where if you kind of change how your money outside of your IRA is invested, you can do a conversion on part of your IRA into a Roth IRA. And here's the bottom line. You know, we're in the legacy business. I'm thinking not just about you. I'm thinking about your kids. I'm thinking about your grandkids. We're even thinking about your great-grandkids, all right, that may not even be born yet. You have an opportunity right now in 2020 to build the foundation for a lasting legacy for you and all of the people that you care about, okay? And please do not waste this opportunity. So two things are happening right now. The stock market is down. That's a good thing for Roth conversion, right? I mean, think about it. If your investments were up here and now they've gone down there and you converted all that money over, that money that went down right there, you're not having to pay tax on that. You move the assets into the Roth, they go back up, right? So this is a real opportunity with the no minimum distribution and the stock market being down. So something else, once you do a Roth conversion, this is where you really need to meet with the attorney, the financial advisor, and the CPA on an ongoing basis. Now, here's why. If I take money out of my Roth, if I take my money out of my taxable IRA, so out of this bucket, and I put it in my Roth bucket over here, I may not want to invest these assets the same way. So what do I mean by that? Well, I may want to have more of my cash investments, the investments that tend not to go up in value as much. I may want to put those in my traditional IRA. I may want to put the growth assets in my Roth IRA, right? Because that's really the last money I'm ever going to take out. And I got to tell you guys something. A lot of our clients, they come in, they say, Jim, you know, I have this IRA. I'm going to use it. You know, my kids aren't going to end up with, you know, forget that. So many of our clients, when they do pass away, they have huge IRAs because they never take money. They only take their minimum distribution out, right? So once you have done the Roth conversion, you really need to pay attention to the investment strategies in the two different buckets. And it may be that you have two separate plans, one for the Roth IRA, one for the traditional IRA, right? It might not make sense to do this sophisticated tax planning when it comes to your traditional IRA. When it comes to the Roth IRA, you don't need the extra tax planning, but when it comes to the traditional IRA, you do.
Yeah. I mean, keep in mind for our IRA trust people out there, I told you, if your kids, if they inherit that traditional IRA, they're going to have to think every year about taxes. When they inherit a Roth IRA, they still have to pull out the money by year 11, but they don't pay tax. So they can just let that money grow during the 11 years. So really there is that huge benefit to Roths. I mean, you know, I did my master's in tax law. The whole time, everyone just whines about all these unjust enrichment under a Roth plan, how it's pretty much, there's all these side effects they weren't expecting, like people getting really wealthy off of the Roth.
Yeah, so some questions. Tina says, are they going to wise up and change the Roth rules? I don't know. They could, you know, maybe, but they haven't yet, right?
You better give me all the money I pay back in taxes for the
Here's
Roth.
what they would do. The issue here is they would probably shut it down, right? They would say no more contributions would be, or no more conversions, no more contributions.
That's exactly.
And then David says, hey, you're talking like IRAs always go up, which has been so since 2008. I think most all IRAs have lost recently. Might take a long time to come back to the value before the pandemic. It might not. We don't know, right?
We don't know. That's exactly it.
We have no idea.
I bought some Apple.
When you convert to a Roth, do the funds stay in like funds? No, you can convert a Roth. This is something very important. When you do a conversion from an IRA to a Roth, you withdraw money. You do not withdraw assets from your IRA. This is very important. Money comes out of the IRA. So you've liquidated some investments in your traditional IRA. You now have a check, and that goes into your Roth, right? So there's a process. That goes into your Roth IRA. You convert that money and put it into your Roth. Those two buckets can be invested completely differently. There's no requirement that they be aligned. It's not like a 1031 or a 1035 exchange.
Okay, very good. All right, so then I want to shift for those who are younger than 59 and a half. You are able to pull out money out of your IRA, 401k right now under the CARES Act. You will avoid that 10% penalty. In a normal year, you pay a 10% penalty on a traditional IRA, and then you pay the tax. So it's a crazy hit if you pull money out of those accounts. Now, right now, this year, they're waiving that 10% penalty if you do take, and that's up to $100,000, by the way. If you do take that money out, you don't have to pay the taxes on it. In 2021, you get a 3-year period to pay the taxes. You can also pay back the money to the IRA or the 401k that you took out, and you won't have any taxes at all. Now, like Jim said earlier, we don't encourage this. This is the last money you should touch. But if there's something in your life, some type of crisis, there is some flexibility right now to pull this money out. Now,
Yeah. So here's something that's important. If you have that 100,000, let's say you had a $200,000 IRA that went to 100,000, and you go, well, I really need this money. I'm going to borrow that out. Well, you've borrowed 100,000. If you had kept that invested, let's say if you would have kept it invested, it would have gone back up to 200,000. You can't put 200,000 in. You got to put back in what you borrowed. So this is kind of like not trying to avoid eating your seed corn. If you're saving for retirement, that really should be the last money that you touch. Obviously, if you need the money, you need the money. But really, I think that should be not your first source of funds. It should be really your last source of funds.
Yeah, I think anyone would agree with that. Just for comparison, if you have a Roth, okay, you have your basis, the money you've contributed, even without all these CARE Act rules, you can always pull out your basis, even before 59 and a half. You don't pay any penalty. You can always get your basis back. But of course, if you take out that growth, you will be penalized and you might be taxed.
And employer-sponsored plans typically have zero basis. So this would only be for contributory IRAs.
All right. So really, what do you do now? So I guess I'll let Jim kind of talk about this.
Yeah. So a lot of our clients have reached out. A lot of people asked us questions in advance. They said, hey, I did this estate plan. I just did this thing a year ago and I spent all this money and you guys did this great plan. I was very happy. And then they changed the rules. This is really confusing. I'm really annoyed. What do I do now? We don't make the rules. We just follow them. We try and keep you informed and we do the best that we can. We're open for business. We haven't let anyone go, since we all went home to go work. We haven't let anyone go. So we're still here. We're still working.
All working remotely.
Here's your homework. Here's your homework after today. Here's what I want you to do. So get your pencils out and write this down. Here's what you do. Look at your estate plan. Number one, look at your estate plan. Get that binder out that you did with us, or you might have done with some other attorney. And do you have the right trustees and beneficiaries? What do I mean by that? Look at the names in the document. A lot of this is in legalese, and many clients, the only thing they understand, frankly, for many people, are the names that are in there. Flip through it, look at the names, make sure, number one, that your healthcare decision makers. And I think this is a lot of people are thinking about this right now. Make sure you've got the right person in there in the right order. Make sure their address is current and correct, right? Their physical street address and their phone number and email, if that's in there, make sure that's correct. That allows the healthcare workers and first responders, if you go to the hospital and it's kind of quick and you don't have time to notify those people, they've got some information to notify them. And if you have a retirement, and I'm assuming if you're on here, you have an IRA or a Roth. If you have any retirement savings at all, please contact your lawyer, which if you're on here, it's probably us, but it might not be. It might be another lawyer, but contact your lawyer, your financial advisor, and your CPA in that order. And this is very important. You want to talk to your lawyer first, figure out, number one, is there anything I need to do? Secondly, if there is something that I need to do, let's get a game plan together and we will create a plan, right, to investigate, does it make sense to look at a Roth conversion? I think if you have a Roth or if you have an IRA and have been thinking about a Roth conversion, now is the time to really pay a lot of attention to this. If you've seen all this stuff and you go, that's not for me, then it's not for you. Third, part of this is, I will tell you, Connor and I, and any other attorney I talk to, frankly, financial advisor or CPA, many times we will give advice, which is frankly the right advice. And sometimes, not often, but sometimes the clients won't take it, which is really frustrating because this is our passion and this is what we get up and this is what we do every day. The third thing to do is listen to your advisors. Don't just shut them out. Now, I'm not saying take their advice, but listen to your advisors. Now, what that means is you've got to reach out to them and contact them and have a dialogue with them, but please listen to them. We have a big heart. We want to make sure that, we're taking care of you, we're taking care of your family, we're taking care of your loved ones, the causes that you care about. Please listen to us. Please listen to your financial advisor and your CPA. If you don't have a financial advisor or you don't have a CPA or you don't have one that you like, just reach out to us and we can introduce you to somebody. I'll tell you, a lot of people, when they retire, their financial advisor's retiring and their CPA's retiring when they retire because they're typically around their age. So, we get it, but look at your estate plan and reach out to your attorney and listen to your advisors.
Very good. All right. So I do appreciate everyone here coming today and listening to us. Really, people always ask us, or they ask me, why Cunningham Legal? What's your call to action? All that good stuff. And I always tell people, our whole goal is to be available for our clients. A lot of our clients, when they walk into our office, they're going through the toughest time in their life when their parents passed away, their spouses passed away, their siblings passed away. And we are there for our clients during that time, just like we try to be there for our clients during a time like this. Now, I'm going to allow questions and answers at this time. I encourage anybody who wants to make an appointment to make an appointment. Go ahead, Jim.
Yeah, James asked a question. If I don't establish a trust IRA prior to my death, will my children, through my financial institution, arrange to receive their inheritances over a 10-year period? Maybe. Now, I mentioned very briefly, we're not going to get in the weeds on the technical stuff. There's a lot of stuff that a beneficiary has to do within a certain period of time. Otherwise, the beneficiary has to take the money out over a 5-year period, sometimes a 1-year period. Okay? So it's very important they not mess it up, is the bottom line. And many, many times, those are completely messed up, not because the people are irresponsible, but they simply don't know what they don't know. And you got a lot of cooks in the kitchen. If you think about it, when somebody passes away, you've got a lawyer, you've got a CPA, you've got a financial advisor, you have the financial advisor's supervisors, and then you have the institutions to deal with. And so there are a lot of ways that you can mess things up. It's very important to have a clear plan of action when somebody dies when it comes to IRAs. Otherwise, the government ends up getting half the money. And then what's the dollar amount to convert yearly from IRAs to Roths? There is no limit. I don't think there is a limit, is there?
No.
You're paying tax. I mean, the effective limit is how much you can stomach paying in taxes, right?
Yeah, exactly. And to be honest, a Roth conversion makes more sense for some than others, depending on what bracket you're in. If you start pulling out enough money, you're going to hit that 50.3% bracket eventually if you're in California.
All right. So I think that was it. Any more questions? Can we get a copy of the deck?
Sure. I mean, we have to ask the higher ups essentially if they don't have a problem with it.
I'm the higher up, but yeah, I don't have a problem with it. Tina, shoot Connor an email. C. Clemons or Jim at CunninghamLegal.com. And
yeah, C. Clemons. So it looks like CC Lemons at CunninghamLegal.com.
CC Lemons.
I had to tell
I love it. I love it.
But yeah, if you found this presentation to be helpful, please pass it on to anyone you think who could benefit. I appreciate everybody staying here today. Oh, I guess we have a couple more questions coming in. Let's see. What time is it right now? 12:24. So we have Gloria. Our beneficiaries are not in CA, so does CA taxes apply? Great question. No, it's going to be in the state your person pays taxes in.
Oh, hold on. No, hold on.
Go ahead.
If you have an IRA trust, something you guys need to know. If your trustee is in California and subject to California tax, any income that is not distributed is subject to California income tax. Secondly, on the IRAs, if your kids inherit your IRAs and they live in California and they want to do any kind of tax planning, you better think about getting an IRA trust and not have it in California and not have a California trustee, because the fact of a trustee who is a California resident on a trust subjects the income of that trust to California state income tax. And that's a really big deal. That's a great question.
That is a great question. You know, I've already seen clients set up these IRA trusts, name that Nevada trustee because they know their kids, they're working in California now, but they don't want to retire in California. They want to go to Florida or Texas or Seattle. And when you live in one of those states and you pull out money out of your parents' inherited IRA, you don't have to pay state income tax on it. So they set up that Nevada trustee to delay paying the tax. And by the time they actually take out the money, they have no state income tax.
And then Ali Cow asked, which type of attorney do I need you to talk to? Before advisor and CPA? That would be us. That would be Connor or me, preferably Connor. No, I'll do it. But talk to an estate. It's an estate planning attorney, a certified specialist. Connor has an LLM in taxation and took and passed the certified specialist exam, and he's waiting for his final seal of approval from the powers that be at the state bar. But everyone's going at home. Yeah. Does Cunningham have an office in Nevada? No, but we have a trust company in Nevada that we work with very, very closely. But we can help people, frankly, in any state. And we can help you get through that process.
Yeah, just reach out to us. I mean, we have plenty of connections in Nevada, so we can help lead you in the right direction. And then what do you mean by Nevada trustee? Does that have to be someone who lives in Nevada? Well, typically we encourage a professional fiduciary called Premier Trust Company. We have other relationships as well, but that's the one we use the most. And so it's a company that acts as trustee. And that company, they're governed by the rules. They're like a resident of Nevada, so they don't have to pay that state income tax because Nevada has no state income tax. All right, so any other questions? Otherwise, we're gonna wrap it up. But if anyone has questions, I'm happy to answer them for you.
Well, folks, thank you very much for attending today, and stay home, right? We're all here. We're trying to get through this thing, and what a weird world we're going to be entering when it all is. It's just going to be different. So, anyway.
All right. Thank you very much. Have a good end of your week.